The $3 trillion private credit illusion has shattered. Institutional gatekeepers are actively restricting retail capital because the underlying assets are entirely illiquid under stress. This is not a standard market correction. This is a silent bank run. Look at the raw data. BlackRock's HPS Corporate Lending Fund manages a massive $26 billion. In the first quarter alone, investors demanded $1.2 billion in withdrawals. That equates to roughly 9.3% of the fund's total value. BlackRock did not honor the full amount. They authorized only about $620 million in payouts. They deliberately hit the fund's strict 5% redemption cap to freeze the rest of the capital. The mainstream financial media frames this as routine portfolio management. They are willfully ignorant. The wealth management complex poured billions into these vehicles, promising retail and high-net-worth investors higher yields and a safe haven from public market volatility. They sold the concept of the semi-liquid asset. That label is a mathematical fraud under stress. The underlying investments are not tradable securities. They are direct corporate loans. These loans sit on the books for years. They rarely trade in public markets. When redemption requests flood in, asset managers face a brutal reality. They cannot sell these loans fast enough to meet the demand without taking massive, catastrophic haircuts. You cannot sell what has no bid, so they lock the gates. They enforce the caps. They freeze your money. This system functions flawlessly as long as new capital continues to flow in and redemption requests remain moderate. But the moment confidence fractures, the terminal liquidity mismatch becomes glaringly obvious. This is not a drill. Private credit has ballooned into a $3 trillion market over the last decade, absorbing the corporate lending demand after traditional banks retreated following the global financial crisis. It is operated in a vacuum of easy money and blind yield chasing. Now, the cost of that blind faith is coming due. When one of the world's largest asset managers activates redemption limits on a flagship credit fund, it is a definitive signal. The underlying paper does not match the physical reality. The institutions know it. They are managing the exit. You are either reading the fund mandates and pulling your capital early, or you are becoming exit liquidity for the gatekeepers. Verify the data yourself. The numbers are public. The mainstream financial press tells you this is a temporary rebalancing. They say the private credit ecosystem is structurally sound, and these price dips in the alternative asset sector are buying opportunities. That is not analysis. That is damage control. Let's look at the tape. Watch the price action. The market is aggressively repricing shadow banking risk in real time. This is not a drill. The tape shows institutional distribution accelerating across alternative asset managers. The moment the news of BlackRock's withdrawal restriction broke, the tape reacted violently. BlackRock's stock took a severe hit. But the critical signal was not just BlackRock. The pain did not stay quarantined. It immediately metastasized across the entire alternative asset sector. Look at the specific Tier 1 players. KKR and Blue Owl Capital both suffered stock drops exceeding 5%. A 5% haircut on Apex alternative asset managers in a single session is not retail noise. It is institutional capital aggressively de-risking. Smart money violently reassessed the sector's risk profile. When institutional desks see a flagship fund freeze redemptions, they do not wait for the contagion to reach their own balance sheets. They sell. They sell hard. This is stacked logic in motion. BlackRock restricts withdrawals. The illusion of semi-liquidity shatters. Institutions immediately realize the entire private credit market shares the exact same structural flaw. They hit the bid on the publicly traded asset managers to escape the underlying illiquidity of the private funds. They are dumping the beta. The tape does not lie. While the commentators preach calm, the aggressive downward price displacement in KKR and Blue Owl tells the true story. The informed minority is not buying the dip. They are using mainstream complacency as exit liquidity. They are front-running the inevitable wave of secondary redemption freezes. The tape shows a structural break. The baseline assumption of infinite liquidity in shadow banking is dead. The repricing has started. Now zoom out. Let's look at the mechanical constraints of this ecosystem. The wealth management complex built a multi-trillion-dollar empire on a concept called the semi-liquid fund. That is not a financial innovation. That is a mathematical fraud under stress. They marketed these vehicles to retail and institutional capital as a safe harbor. They promised the convenience of periodic withdrawals. But the paper promise completely ignores the physical reality of the collateral. The assets sitting inside these massive portfolios are not publicly traded equities. They are not liquid sovereign bonds. They are fundamentally illiquid direct corporate loans. These are bespoke debt instruments. They sit on a ledger for years. They are rarely traded in secondary markets. This is the primary structural anomaly. This is the terminal liquidity mismatch. When fear enters the market, the redemption wave hits. The asset managers instantly face a brutal, inescapable math problem. They cannot sell these direct loans fast enough to satisfy the sudden withdrawal requests. You cannot sell what has no bid. To liquidate these assets under stress, the funds would have to dump them into a frozen market. They would have to absorb massive, catastrophic haircuts. The fund's net asset value would collapse. They will not take those losses. So the mechanic fails. The managers pull the emergency lever. They institute the caps. They freeze your capital. This is not a temporary liquidity squeeze. It is the exact moment the structure of the semi-liquid vehicle is exposed as a trap. As long as new capital flows in, the redemption requests are paid out. The illusion survives. But when confidence shakes, the inflow stops. The exit door shrinks to the size of a keyhole. If multiple funds are forced to liquidate simultaneously, the bid stack disappears entirely. The price collapse becomes violent and guaranteed. You can read the fund mandates, check the underlying asset liquidity profiles. The gatekeepers know exactly what they are holding. They are front-running the exits while telling you to stay calm. The underwriting rot is systemic. A decade of yield-chasing bred horrific due diligence. The defaults are now bleeding through the paper facade. The paper does not match the physical reality. This is not a localized string of bad luck. It is a full-scale institutional failure. Look at the collateral. High-profile blow-ups like First Brands Group and Tricolor Holdings have explicitly shaken investor confidence. Why? Because the underlying collateral and financial information were fundamentally misrepresented. The asset backing the debt was an illusion. The pressure moves up the chain. An HB's-led consortium just swallowed a massive $400 million loss. The catalyst was not macro headwinds. It was a fake invoice network tied to telecom merchant brand Kim, a $400 million hole driven by fraudulent invoices does not happen in a functioning credit market. It happens when underwriters are blinded by the fee structure and the desperate need to deploy capital. These are the mechanics of capital destruction. As macro volatility rises and geopolitical tensions apply external pressure, the internal credit structure is exposed as hollow. Smart capital is making a deliberate, quiet judgment about where real value resides. The apex players see the data. JP Morgan CEO Jamie Dimon understands the math. He delivered an explicit structural warning regarding this exact market. His assessment of these early loan issues: when you see one cockroach, there are probably more. He's right. These isolated defaults are just the early warning sirens of a deeper systemic infection. The risk is no longer theoretical. It is repricing the entire shadow banking system in real time. Now the honest case for caution, because balance is what separates analysis from promotion. The bear case of immediate systemic destruction requires a total cascade failure. That is not a certainty. That is a probabilistic extreme. The apex players are not surrendering to the panic. They are actively fighting the run with raw capital. They are deploying balance sheet strength to plug the structural holes. Look at the data from the top of the food chain. Blackstone faced a massive withdrawal wave. Requests approached 8% of the fund's total assets. A wave that size is designed to break the semi-liquid illusion. Blackstone did not let it break. They did not implement strict redemption limits. To prevent widespread panic, they injected $400 million of their own proprietary capital. They absorbed the outflow. They honored the redemptions. That is the counter-thesis. The system does not collapse if the primary gatekeepers can simply buy their way out of a liquidity squeeze. It is not a death spiral if the institutions confront the cash. But look closely at the mechanics of that defense. It is an isolated, desperate firewall. It is mathematically unsustainable across the broader ecosystem. Throwing $400 million at a redemption wave is a luxury very few firms possess. The vast majority of private credit managers do not hold enough liquid capital to cover a fraction of that demand. They are running lean. They are fully deployed. The defense strategy at the apex does not scale. The dark contrast sits right next to it in the tape. Blue Owl Capital took a radically different path. They did not deploy proprietary capital. They completely halted redemptions on their next fund. Their statement was absolute. They would pay nothing. Look at the data from the top of the food chain. Blackstone faced a massive withdrawal wave. Requests approached 8% of the fund's total assets. A wave that size is designed to break the semi-liquid illusion. Blackstone did not let it break. They did not implement strict redemption limits. To prevent widespread panic, they injected $400 million of their own proprietary capital. They absorbed the outflow. They honored the redemptions. That is the counter-thesis. The system does not collapse if the primary gatekeepers can simply buy their way out of a liquidity squeeze. It is not a death spiral if the institutions confront the cash. But look closely at the mechanics of that defense. It is an isolated, desperate firewall. It is mathematically unsustainable across the broader ecosystem. Throwing $400 million at a redemption wave is a luxury very few firms possess. The vast majority of private credit managers do not hold enough liquid capital to cover a fraction of that demand. They are running lean. They are fully deployed. The defense strategy at the apex does not scale. The dark contrast sits right next to it in the tape. Blue Owl Capital took a radically different path. They did not deploy proprietary capital. They completely halted redemptions on their next fund. Their statement was absolute. They would pay nothing. That is the reality for the rest of the market. When the cash buffer fails, the gates slam shut. Blue Owl's complete freeze sent shockwaves of systemic liquidity fear through the sector. It proved that the liquidity guarantee is entirely conditional. It relies on the manager's goodwill and their proprietary balance sheet, not the underlying asset. The honest case for caution dictates that Blackstone's intervention bought the market time. It slowed the momentum of the run. The buying time is not fixing the structural rot. The math remains broken. The illiquidity of the direct corporate loans has not changed. The apex players are bailing out their own retail funds to save the broader narrative. It is a flex of raw financial power, not a sign of systemic health. The liquidity vacuum is simply waiting for a withdrawal wave larger than the gatekeepers' cash reserves. This entire $3 trillion shadow banking apparatus was born from a regulatory void. Banks abandoned corporate lending after the global financial crisis due to strict regulations. Private funds stepped in to fill that void. Now, the math dictates a forced deleveraging. This is not a functioning market. This is a trapped ecosystem. If multiple funds are forced to liquidate direct corporate loans simultaneously, The complete lack of buyers guarantees a violent price collapse. Look at the convergence of the data. You have a $26 billion fund capping withdrawals to freeze retail capital. You have Apex players burning $400 million in proprietary cash to mask the run. You have immediate total halts on redemptions, sending shockwaves of systemic fear through the sector. You have the tape violently punishing alternative asset managers the moment the illusion cracks. The ultimate financial reality is absolute. Liquidity always appears abundant right up until the exact moment everyone demands it at once. You are either reading the fund mandates and pulling your capital early, or you are becoming exit liquidity for the gatekeepers. This is financial warfare education, not advice. Protect your capital. Invest with logic, not hype.